In this week's video, we'll review the latest charts and data to help us answer the question, are comparisons to 1929 justified or overblown? Back in the 1920s, the Dow Jones Industrial Average was the major average to watch. The 1929 to 1932 bear market saw the Dow Jones Industrial Average lose approximately 89% of its value. You heard that correctly, 89%. This is what the weekly chart looked like at the peak on September 3rd, 1929. Unbelievably, the Dow Jones Industrial Average was 82% above its upward sloping 200-week moving average. And since tech stocks have been the major topic of discussion over the past 2 to 3 years, we'll also take a look at the dot-com bust bear market and the peaking process in the NASDAQ Composite. The day the NASDAQ Composite peaked on March 10th of the year 2000, it was a whopping 154% above its upward sloping 200-week moving average. And why is that relevant? The distance between where price is and this level here is basically one way to define risk. We all know it's not unusual for a secular trend to make a stand at or near an upward sloping 200-week moving average. So to recap, when the Dow peaked in 1929, it was 82% above its 200-week moving average. When the NASDAQ peaked in the year 2000, it was 154% above its 200-week moving average. If we take the average of those two numbers, 82 and 154, we get 118%. How does that compare to the S&P 500, the major index in the present day, and the NASDAQ Composite? Are we extended 118% on average above the 200-week? We are not. When the S&P 500 peaked earlier this year, it was 33% above its 200-week moving average. And when the NASDAQ Composite peaked late in 2024, it was 42% above its 200-week moving average. If we take the average of those two numbers, it's 37.5. And if we compare that to the average of the 1929 and 2000 cases, you can see in terms of risk, we're really not extended in any shape, form, or fashion that says we're similar to 1929 or the year 2000. Now let's look at it from a different perspective. Just how extended was the Dow when it peaked in 1929? If you look backwards 3.1 years, it had gained 142%. From the peak in the year 2000, if you backtrack 3.1 years, the gain was an astonishing 279%. Bubble-like in both cases. The average of 142 and 279 comes to 211%. How does all of this compare to the present day? 3.1-year change for the S&P 500 prior to the peak in 2025 was a much more muted 28%. If we look back 3.1 years from the NASDAQ's peak in 2024, the gain was a much more muted 26%. And the reason why we're using 3.1 years, it's 3.1 years from this peak in 2024 back to the prior peak in 2021. So to make sure we're comparing apples to apples, in every case we use 3.1 years. We could change it to 3 even, and the analysis would basically produce the same outcome, which is the present day doesn't really look anything like 1929 or the year 2000 when we compare the Dow, the major index of the day, to the S&P 500, the major index of the present day, and we compare the NASDAQ in the year 2000 to the same NASDAQ Composite in 2024 and 2025. 27% really doesn't look anything like, not even remotely close to 211%, and 37.5% really doesn't look anything like 118%. In fact, the relatively normal and muted nature of the extension from the 200-week moving average and the gains over the past 3 years seems to align with, rather than contradict, the Bank of America Merrill Lynch thesis that we're in a secular bull market that could last until 2031 to 2035-ish. And that comes from a tweet dated April 17, 2025. And the concept of being within the context of a secular bull that could last until the mid-2035s, that sounds familiar, doesn't it? And it's really not a coincidence that their independent research comes up with 2035, and our independent research also came up with 2035 several years back. As we walk through this week's video, it's incredibly important to keep the concepts in the lower portion of your screen in mind. The bearish case in the present day is easy to understand. It's being covered in newspapers, it's being covered on TV, it's being covered in coffee shops, over the dinner table, and on social media. It's much harder to keep an open mind about better than expected outcomes. Thus, in this week's video, we're going to ask and answer. Is there any data that supports the bullish case? Hard data. We're not interested in opinions or forecasts. And really what we're asking in this week's video, if we look at last week's low from 2 weeks ago, the day when the tariff news became less bad with the tariff pause, other than the fact that that low was made, for the most part, exactly at the upward sloping anchored volume weighted average price line shown in blue that's tied to the major low in October of 2022, do we have any other data in hand that tells us it's reasonable to try to be patient in this area here? Is it reasonable to think it's possible that we could have either made a bottom or we're in the process of making a bottom? And if it's a bottoming process, it wouldn't be unusual to retest this low or even undercut that low. And we have another reference point on this chart, the orange line, at approximately 47.40. And that's the anchored volume weighted average price line tied to the January 3rd, 2022 peak. This is the chart that we covered in the April 4th video. The S&P 500 closed at 50.74 on April 4th. How does the same chart look as of the close this week, and how do the secular trend and secular volatility model scores look? Most of these scores over here are higher, and these scores tell us, if you're a client, that we are allocated properly and prudently based on the strength of the long-term trend and how these scores have acted in the past within the context of a long-term secular trend and within the context of a period where the trend rolls over and ends. It's probably fair to say to date, there's really nothing on this chart up here that looks different from any other portion of this secular trend that began somewhere in this window here between 2011 and early 2013. And as we noted on April 2nd, the market will most likely find a bottom when maximum tariff fear has been reached. Well, there are many ways to potentially measure maximum tariff fear, all of them looking at probabilities, probability of good things happening and the probability of bad things happening. In terms of points on the S&P 500, fear was in a better spot at the end of this week. Relative to that April 4th chart, we closed this week 208 points higher. Similar concepts here. There's nothing on this chart to date that says the secular trend is over or really even in doubt at this point. And that applies to price relative to the moving averages, and that applies to the indicator down here. Present day looks basically identical to the movement since 2010. It looks very, very similar to the movement of the indicator during the secular trend between 1982 and the year 2000. And the same can be said for the secular trend that began in 1950 and ended in 1968. And the present day over here on April 17th really doesn't look anything like this, and it really doesn't look anything like this. The same is true for price, and price relative to the present day. How about initial jobless claims? We showed this chart last year that told us, for the most part, jobless claims start to rise noticeably before the start of a recession. This is the updated version of the chart that we showed last week. We really just don't have any movement. The trend in initial jobless claims has basically remained unchanged since January of 2022. And we know the narrative is that tariffs will cause inflation, and that may be the case. But in terms of the chart in front of us, the chart of CPI here and core CPI is unequivocally and unquestionably in a downtrend, and it's been in a downtrend since 2022. And while we hear definitively all the time that tariffs cause inflation, the market doesn't seem to be positioning itself for accelerating inflation. This is energy stocks XLE relative to IEF 7 to 10-year Treasury bonds. You can see in January of 2022, notice the ratio starts to rise rapidly as concerns about inflation start to increase. That same ratio, is it rising rapidly? No. In fact, it just recently, just a few sessions ago, made a new 23-month low. This doesn't appear to be market participants that are concerned about an imminent spike in CPI. We also hear a lot that the bond market is suddenly in trouble. The bond market's been in trouble for a long, long time, and it's most likely concerned about runaway and unchecked deficit spending. Between fiscal year 2015 and fiscal year 2020, the U.S. budget deficit increased by over 600%. And it's no coincidence that that's where people started selling long-term Treasury bonds, concerned about the deficit. Now, having said all of that, we've come back to an area tied to these levels way back here in the 80s, and it looks like the 30-year bond is trying to make a stand. This is value stocks relative to tech stocks, and this is one of many charts that we need to watch closely. This is January of 2023, after the major low in the stock market here in October of 2022. The NASDAQ bottoms right in here. This is where tech stocks started to significantly outperform value. You can see if we come back from this transition area, we're back into this area now, and thus far we were rejected. There's no question this looks different from most of this in here. So we have to keep an open mind about this ratio pushing into this area here. For now, it came up into this area and then came back down rapidly right at the same time the stock market bottomed. So we can be patient in this area to see how it unfolds. Again, the narrative is, it's really not even up for discussion. Tariffs cause inflation. This is what BSV, Vanguard short-term bonds, looked like when the market was concerned about inflation. This is January of 2022, concerned about the Fed raising interest rates. We really don't see anything like that. In fact, we broke out above that level and have since been consolidating above it. The look of the chart here doesn't look anything, not even remotely close to anything from Q1 of 2022. And it, too, is really not in alignment with the definitive statements that are being made that we all know that tariffs cause inflation. And yes, the base case is that they typically would cause inflation. But the market doesn't seem to be overly concerned about inflation. Quote from Warren Buffett, "Forecasts may tell you a great deal about the forecaster. They tell you nothing about the future. Yet investors often seek them out for comfort in an unpredictable market. Human beings don't like uncertainty, hence they like forecasts. But we need to be thinking in probabilities. That's what we're doing on April 14th here. We can see that the market's coming back up to an area here where it could start to run into some resistance. And then on April 15th, what you're doing is you're trying to understand where your guideposts are. This is the S&P futures. This area in here, the gap down from the announcement of the tariffs, 55.66 potential resistance. The market did come up into that general area, and then it did start to backtrack. At that time, we said, we'll learn something, basically, when we come back to 5,300 potentially, all the way back to 5140. And then if they didn't hold, we had reference points at 5025 and 5074. This was tweeted when the S&P 500 was trading at 5438. If we fast forward to the close on Thursday, the markets were closed on Friday for Good Friday. You can see we did come up into that area, 55.66, right around that area. It did act as resistance. And then we came down, and we've been testing 5,300. And thus far, it appears that the market does believe that this band between 5,300 and 5,140 is an area of support. Now, at 4 p.m. on Friday, the futures closed at 53.12. They popped after the close, 14 points higher. They finished at 53.26. And in terms of maximum fear in the futures, they came on April 7th when the futures printed the recent low of 48.32. Friday's close was 494 points above the max tariff fear level. Now, that doesn't mean this is going to hold, but it's very, very easy to remain patient as long as the market is not signaling that we have a new max tariff fear level. Right now, it appears, based on the chart in front of us and based on the chart of the S&P 500, that tariff fear has started to subside a little bit. It has started to become less bad. April 14th tweet, it tells us to keep an open mind about the low being in place or being very, very close to being in place. A move like this in the VIX has only occurred 2 previous times in the VIX's history, after the major low in 2009 and after the major low in 2020. The maximum drawdown was approximately 3.55%, telling us it wouldn't be shocking if the S&P 500 backtracked to 5203-ish or 5213-ish. We also have a tweet in the feed about the sequential count being on a 912. A 913 signals potential trend exhaustion, meaning this downtrend could be over. The last time we got a 913 in this direction was the exact day of the low in October of 2022 when the correction ended. If this count finishes, and that's all hypothetical, it may or may not, to get to 13, we would have to fall below the close of the 8-bar here, which was 96.75. That's about 4.3% below Friday's close, but it's also about 5.5% above this low, which tells us to get the 913, we would basically just stay in the trading range. And thus, we have to be willing to be patient, see how things unfold. All of this price action here is occurring within the context of an S&P 500 that's above an upward sloping 200-week moving average, which still looks like a secular trend, and in the context of a secular trend score that's still sitting at 100. DeMark has 4 major counts. The combo count is on a 911. So if we were to get a 12 and eventually a 13, it implies that we would have a close below 5012. Now, we don't want these counts to create bias. You may look at them and say, well, we know we're going down. We don't know that at all. We're assessing probabilities. These counts are helpful because if the market comes down and we get the 913s, it's easier to remain patient. Markets can bottom without this count completing, and markets can bottom without this count completing. This is a reference point, and this count is a reference point, and there's simply a small portion of the weight of the evidence. So even if the market is trying to make a bottom, given this strong downward momentum here, even under the best case scenario, it's not unusual for it to take time for that downward momentum to dissipate, which means we have to be mentally prepared for the market to fall again into this region here. If it doesn't hold, then we'll learn something about increasing bearish probabilities. Right now, we're in a trading range, and until we break out of that trading range in a meaningful way, we're most likely not going to be making a lot of adjustments to our allocations either way. So the only way any of this, anything that we're covering this week, can be useful is if we're not making any assumptions about what's going to happen next, and we just take it day by day and continue to assess the probability of good things happening relative to the probability of bad things happening. And remember, the VIX study that we just covered said it wouldn't be unusual, even if we had a good VIX signal, that the S&P 500 backtracks to 5,200-ish. The futures in the S&P are pretty much in alignment. 5,200 is in this region here. Thus, the VIX study and the two counts tell us, even if good things happen related to this, and this, we have to be willing and mentally prepared for the market to fall potentially somewhere between 120 and 320 points. Not a prediction in any shape, form, or fashion. We may never revisit this region here. We also have to keep in mind all of this price action is occurring above the 200-week moving average at 46.25. And while the current administration may not care about the stock market in the short run, in the long run, the stock market matters in a big way. We're only 19 months away from midterms. From their perspective, it doesn't do them any good if they get blown out in the midterms. So this absolutely positively will factor into their decision-making process in the coming days, weeks, and months. We already covered the tweet that we had on April 14th. A day later, April 15th, Jason from Sentiment Trader said, we potentially have a bear killer setup where the VIX cycles from above 50 to below 30. We noted during the trading session on Thursday that the VIX had dropped below 30 for the second time intraday this week. As it turns out, at the close, we did get our first close below 30. In terms of the bear killer signal that was nailed down at the close of Thursday's session, 1 year later, 100% of the historical cases, the S&P 500 was higher. The median gain, 17.9%. The average of these numbers here, 22.87%. The first one comes after the major low and after the 1987 crash. The second one comes as the market is bottoming at the end of the dot-com bust bear market. And the third one comes in close proximity and after the major low at the end of the financial crisis. The fourth one came after and in close proximity to the major low after the COVID crash. Now, if you've been in the markets for years, you probably remember that 2011, 2016, and 2018 also featured multi-week periods of concerning headlines and plunging markets. When the headlines started to shift, in this case, and this case, things improved significantly. It's only been 11 trading sessions of headlines since the tariffs were announced. We have to understand that if the headlines start to shift and we're on the other side of maximum tariff fear, it is possible that things will start to improve. The bearish scenario would be that if we're heading into a recession. If that's the case, and the data that we have in hand does not support that, then it could take months before we see the final low. Now, investors have been rushing into foreign stocks. You can see that here. But if we look at the long-term trend of global stocks, ACWI, which includes the United States and is heavily influenced by the United States relative to foreign stocks, with the United States removed from the equation, the uptrend that's been in place for years is still intact. And it's not unusual for it to be popular to move into or see foreign assets outperform the U.S. during risk-off periods. And it's not unusual for the U.S. to start to outperform again near major turning points in the stock market. If we remove the moving averages, you can see the uptrend still intact, and we've come back here. What once acted as resistance may now act as support. If this ratio moves into this area here, then we'll learn something about probabilities associated with the trend flip. For us, and for our time frame, we're better off being patient with the assets we own and see how it plays out. By the way, you'll notice this tweet and this chart tend to align. A third party here saying basically the same thing. The long-term trends favoring the United States remain very much intact. Another quote on forecasting. The great error of forecasting is that people think they can eliminate uncertainty. Investors cling to predictions because they crave the illusion of control. Thus, if somebody is telling you what the stock market's going to do, you should probably take the statements that follow with a grain of salt. We're much better off thinking in probabilities and scenarios. For example, scenario 1, gold relative to the S&P 500 breaks this downward sloping trend line. How would we handle that? Well, for us, we would be more open to adding to our position in gold. The second scenario is that the current trend remains in place and the ratio bounces away from the green line, So this is another area for us. Let's see how it plays out. We're going to get good information very, very soon if we're willing to be patient. And if we look at the high-low close bars here, there's a bar, there's a bar. This would imply that the stock market could fall further. And this is the region here where we would learn something. And there's a reason, a very good reason, why we're being patient here. Because it's prudent to ask and answer. How did gold perform relative to the S&P 500 walking forward from point A and point B? And you'll notice in both cases, gold was outperforming. In this case, gold had been outperforming for some time and was above the 200-week in terms of the average. The answer to this question up here? Walking forward from point A after a period where gold outperformed the S&P 500, that shifted in a big, big way when that line acted as resistance. Between February 11th, 2016, for the most part just as the S&P 500 was bottoming, and September 20th, 2018, SPY gained 68% and change. GLD lost 4%. How about point B? Gold had been outperforming really for a long time. Felt really, really good to own gold here relative to stocks. But after point B, it didn't feel so great. March 23rd of 2020, again, right near a major low. The window that extended to January 4th of 2022, SPY gained 119%, GLD 15%. We don't have any bias at all relative to this chart. In fact, we've pointed out several times that there's a higher probability of a breakout here because when we look at the 200-week moving average, it's starting to turn up down here. That was not the case here, and that was clearly not the case here. So we're open to adding to gold, or we're open to holding what we have. Here's that period in here in 2015, 2016, where we had concerning headlines, and then they shifted quickly. Secular trend remained intact. Concerning headlines in here for several weeks in 2018. The headline shifted in late December. The market bottomed on Christmas Eve, and then the news started to improve in early January, and the secular trend remained intact. And in the early stages of this bull, the same thing happened here in 2011. Terrible headlines coming out of Europe, and then they flipped. So we really don't want to make drastic changes to our portfolio until the data supports making changes based on 11 trading sessions. A lot can change in the next 11 trading sessions, and that may be in a positive manner or a negative manner. But right now, this unequivocally looks similar to this entire secular trend in here. Now, a prediction or a forecast would say that this is a year 2000-like decline, or a year 2007-like decline, or a 1929-like decline, and it's inevitable that we're going to get down here. That may or may not happen, and we're happy to put a higher probability on that scenario when the data, the weight of the evidence, starts to lean that way. We just don't have that yet. We have to understand our own psychology. Investors are often drawn to forecasts because they promise certainty in a world that is inherently uncertain. I believe we had mentioned this on Twitter. We performed a study a couple of weeks ago relative to where the market tends to make a stand in double-digit drawdowns relative to the proximity of the 200-week moving average. You can see as of April 17th, we haven't done anything out of the ordinary. Every single one of these lines occurred within the context of a secular bull market, where eventually the market went on and printed a higher high and the secular trend remained intact. In fact, the cases that are most like our current drawdown, in terms of proximity to the 200-week and the drawdown that we have, the max draw thus far, being patient and keeping an open mind was highly rewarding. Average gain 1 year later, 33%, 2 years later, 55%, 3 years, 64%. This is not a signal, it's not a forecast. It's just reminding us, as long as it looks like a secular trend, we can't just think about red screens and pessimistic newspapers and newscasts. We have to keep an open mind about a wide range of outcomes, from wildly bearish to wildly bullish. Similar concepts here. RSI recently closed below 30. We performed a study of when that happened. Happened 11 previous times in these secular trend windows up here. If you were patient, the average gain in the S&P 500 6 months later was 12.26%. Only one time within the context of a secular trend were you lower in 6 months, and that wasn't even that bad. 1962, 6 months later, the market was down an additional 6%. Once again, nothing in here that's out of character with the secular trend at this point. If we get outside of these bands, the further we get away from this cluster, the more meaningful it becomes in terms of bearish probabilities. So we'll learn something either way. We always say it's important to maintain realistic expectations about how markets operate in the real world. These are the cases that we just talked about. Notice, there's a lot of yellow and red on this table looking out 1 week to 3 months and even 6 months in the 1962 case. But you'll also notice this. If you were patient and it still looked like a secular trend and all of this was happening either at or near an upward sloping 200-week moving average, remaining patient and not getting too one-sided in your thinking paid off in a big way. Average gain 1 year later, over 27%. And the maximum drawdown on the date of the signal here tells us it wouldn't be unusual if the S&P 500 backtracked to 4751 or 4831-ish, which is very, very close to the low that's already been made right around 4800. Stat here from CycleSpan that says basically what we've seen thus far, all of the previous cases historically were near major lows. Also points out something that we've pointed out on Twitter or X, that breadth has been better than expected over the past 4 trading sessions. Market's still holding above these 3 reference points that we covered last week. This chart is dated April 17th. Jeff combines 3 sentiment readings and he tweets, you're looking at the highest reading on record in 1,841 weeks of stock market sentiment observations. Basically saying between 1990 and 2025, the most pessimistic or bearish reading ever seen. 10 out of the last 11 cases, the S&P 500 was higher 12 months later, and the only case it was red was down an additional 6.6%. But look at some of these returns. 19%, 59%, 36%, 21%, 21%, 30.5%, 25%, 21%, 31%, and even a very respectable 11.5%. Bloomberg article, Bank of America poll shows investors haven't been this bearish in 30 years. Larry noted high volume reversal. We just experienced one. There were similar spikes near the major low in 2009, 2010, 2011, and 2020. The only time it didn't work, 2008. And as we noted over here, 2008, the trend was much, much weaker relative to the other cases and relative to 2025. From Jay, the sentiment trader panic euphoria model doesn't drop below negative 30 often, but when it does, average gain 1 year later, 100% of the cases higher, 31%. 6 months later, 18%. Simply telling us to keep an open mind about better than expected outcomes. Daily chart book, tweet April 12th. History strongly suggests both the NASDAQ 100 and the U.S. large cap tech sector should rally over the next 50 trading days and by double digits. All based on hard data and something that just happened in 2025. Keep hearing about how awful consumer sentiment is. In fact, recently we were told that sentiment in the present day was similar to readings in 1952 and 1981. Things went pretty well walking forward from 1952. The S&P 500 gained 352% to this peak in 1973. Walking forward in 1981, if you had a long-term time horizon, they went extraordinarily well. The gain between 1981, the end of 1981, and this point here in 2000, 1146. Tweet from Seth. When this happens, historically, 100% of the cases, the stock market was higher. Average gain a year later, a hair under 30%. From Jay, Sentiment Trader, NASDAQ 100 performance after the VIX crosses below 45. 1 year later, 94% of the cases, the NASDAQ 100 was higher. Median gain over 46%. Sentiment readings. Investors have only been this pessimistic and or gloomy one other time, 1990. And the reading that's similar to the present day came very, very close to the S&P 500 low, the end of the red screens in 1990. If you were patient in here, you were rewarded. The S&P 500 gained 63% from this low with extended sentiment and rare sentiment to this high in Q1 of 1994. Markets tend to bottom when the news becomes less bad. We just experienced the fourth most volatile week in 60 years. The other three, very close to the major low after the stock market crash in 1987. Very close to the major low at the end of the financial crisis, and very close to the major low at the end of the COVID crash. We also have a drawdown to date that came within a hair of a bear market, but we didn't get there. These are historical cases that are similar, close to a bear market, but didn't close below 20%. Average gain a year later in those cases, over 30%. Every single case the market was higher. Capitulation indicator recently signaled. It's extremely rare, and performance walking forward on an annualized basis is silly. When this type of reversal occurs historically, good things tend to happen. You're in Timber from Fidelity. That suggests that investors have priced in enough pain to make it worth taking the other side. Tweet dated April 18th, 2025. He also noted on April 18th that the relatively tame move in the credit markets suggests that the hit to earnings might be contained. Massive flows into money market funds and cash present day here. Similar case here, here, and here. The previous cases all occurred near major turning points in the market and after most of the pain was already in the rearview mirror. We really don't have any hard data in hand at this point that contradicts the secular trend thesis. And typically within the context of a secular trend, if you give the secular trend the benefit of the doubt, more often than not, that pays off handsomely when the S&P 500 goes on to print higher highs. Having said that, if the data in hand starts to morph into something more like this, this, or this, or this, or this, or this, then we have to be willing to reassess those probabilities. And we all know the only way that we can do that properly is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.